In the very near future, we will begin to think about setting 2019 cash rents, and that will be done against the backdrop of trade disputes and the price uncertainty that causes. We discussed that topic in August 2nd, 2018 Farm Doc Daily. In recent weeks, we have seen all corn and soybeans prices decline, including those related to the 2019 production year. If you look at the December 2019 contract, a year in the future, we saw the prices trading above $4.20 early in the year, falling to below $4 and hitting lows of $3.80 in the middle of July. And currently that contract is trading near $4 per bushel for corn. That $4, and again, we're going to be using the December 2019 contract as our gauge for prices for 2019 and setting 2019 cash rents. We subtract a usual basis of 20 cents from that, we get a $3.80 price. Turning to soybeans, we saw the same thing. We saw prices, and again, we're looking at the November 2019 contract here, so we're looking for prices in 2019. We saw soybean prices near $10 through much of the year, that falling below $9 in July, and currently we're looking at prices at $9.30. That again is a futures contract. $9.30 minus a usual basis of 30 cents gives us $9. If we use $3.80 and $9 in 2019 budgets, so we're looking at 2019 budgets here, and I built this for Central Illinois, 210 bushel yield for corn, 65 bushel yield for soybeans. The only revenue that we're building in here is going to, for the budget for 2019, is crop revenue. We shouldn't be expecting payments on commodity titles at this point in time. Non-land cost, we're going to build in a non-land cost of $5.70 for corn, $3.60 for soybeans. We're not expecting those non-land costs to come down in 2019 because of increases in energy prices. Build those prices, you get a budgeted value of $2.28 operator and land return for corn, $2.25 for soybeans, and that's the amount that's left to split between the farmer and landowner, and those numbers will be below average cash rent levels, and we're looking at something like $2.65 for an average cash rent for Central Illinois high productivity land. Here we would be projecting, if we have a cash rent above $2.25, losses to the farmer. Predicting losses to the farmer has not been unusual. We've seen that pretty much since 2014. Cash rents being above returns, particularly for corn, since 2014. Soybeans has sort of come out even or above that, but corn has definitely been below that. We've seen cash rents being sticky, coming down from higher returns in 2011 and 2012 and 13. Hit a high cash rent in Central Illinois of near $2.94 in 2014, and we've been slowly coming down to that $2.64. There has been reluctance to lower cash rents, even given that we've seen on average low to negative returns on cash rents since 2014. Land market is very competitive, and farmers have had the ability to pay low and negative returns because owned land, for example, has been positive returns, and we built up some financial reserves from the 2010 to 2013 period. Farmers, again, are very reluctant to try and lower cash rents because that has the possibility of losing farmland. If we're looking at lower cash rents currently, some of the reasons for taking those low to negative returns is expectations of higher returns in the future. We're going to farm this land and hope that in the future we get higher returns. I would say, in my opinion, that the trade disputes that we've seen recently have lowered those prospects of higher returns in the future. Trade disputes typically have long-run impacts, lowering price, and I would point to, for example, the Russian grain deal, grain embargo. Trade disputes have in my opinion, again, taken the edge off higher prices in the future, and I would suggest re-evaluating long-run prices given the impact of these trade disputes. If those long-run prices come down, then we're looking at the idea or strategy of taking losses now in the hopes of getting higher returns in the future as being somewhat less advisable now than in the past couple years. As far as suggestions for 2019, again, I would suggest reevaluating the long-run income potential from farmland and also suggest some flexibility in setting rents for 2019. Variable cash rents seem like a good way to go in this environment, and waiting to price or put the cash rent on that land till later in this year or early next year probably is warranted given the price uncertainty that now currently exists, because it always exists and the trade situation has added to that uncertainty. You can read my Farm Doc Daily articles, Farm Economics, at Farm Doc Daily.